Hi, everyone. Welcome to Analyze Your Trade, episode number 52 for October 16th, 2018. We are broadcasting live on YouTube at 4:30 p.m. Eastern Time, but you can also listen to the audio-only version of all episodes now on iTunes, Spotify, Stitcher, Podbean, or wherever else you listen to podcasts. Just search for Timing Research and subscribe there. Today we will be discussing your trade ideas, and over the last few days, about 40 people submitted up to 5 symbols each, and I have put the list together, which you should be seeing on your screen now if you're watching the video, and we're going to get through as many of those as we can today. So my name is David Kosmeter. I'm the creator of TimingResearch.com, and I developed this show with Dean Jenkins of Follow Me Trades, and he is here to moderate today, so I'm going to go ahead and turn it over to him.
All right. Hey, thanks, David. It's good to be back. Always enjoy this. It's fun to look at all the stocks that people are interested in and offer analysis. Sometimes we find some good trades here. And boy, we're looking for good trades. It's super interesting times in the market, right? Not a dull moment. But before we jump into it, let's go ahead and introduce our panel. And Neil, if you'd lead off, just 1 or 2 minutes of who you are and what your approach to the markets is.
Okay, thanks, Dean. Yeah, I run the website Trader Review. And I used to be a broker at a big firm, and learned very quickly when I was there during our training. They would send us to the East Coast for a few weeks before we were let loose, trying to get clients. And I learned very quickly that you're not really a financial analyst, you're not really a stock picker. It's really just about selling. And I'm not really the best salesman in the world. I actually prefer to do the research, making the stock picks. And so it was a fantastic time at the firm. I just loved it there, especially the free lunches. The mutual funds would buy us to sell the funds. But I then went on to be a business analyst, and a few years later started Trader Review. And I used the same analysis that I learned when I was a broker, which was point and figure charting, which is just fantastic analysis. And I recently picked up the Ichimoku Cloud, which is used a bit more for the fine tuning. So I put them together, and when they both correlate, you can get some fantastic trades. And then I send those out to my clients.
All right, excellent. And interesting that you're using Ichimoku Cloud, because I use that now as well. Started about a couple years ago. But first, Jim, if you introduce yourself, please.
Sure, Dean. I am Jim Kenney. I provide the content to the Option Professor, and we've done webinars and seminars for decades now, educating people on the uses of risk of options, and we use them for income cash flow purposes, as well as speculative, as well as hedging. And hedging can come in very handy. And in the environment where you go down 1,400, back up 600, all in a very short period of time, being hedged is not the worst thing in the world, I don't think. So some of the hedging tactics that we cover are very, very valuable. And every week we do have a podcast, and at the end of the broadcast here, I'll explain how people could tune into the podcast every week.
All right, and good to be back with you here again, Jim. We've been on the panel once or twice together. Mm-hmm. I'm Dean Jenkins, founder of FollowMeTrades.com, and hey, I'm a trader. Kind of like Neil. I like analyzing charts. I like trading, and I really enjoy talking to traders. I run a live trading room. I have a stock pick service where I send out the trades I'm taking on my own account, and I have some education programs as well for folks that want to learn to trade like I do. And I use a combination of a very simple form of Elliott Wave and Ichimoku Cloud, and I call it East meets West. And when they agree, the results can be really, really good. And you'll see it on my chart here as we get in and start doing some analysis. But again, I'm Dean, FollowMeTrades.com. I'm gonna go ahead and start sharing my chart, because it's all about the charts, man. It's all about the reality of price action. And we've got a pretty good list here, 15 symbols that people have submitted. David's done the work and prioritized them, the ones that came up the most often. And we're going to start here with Facebook, and we'll keep that order. So, Neil, if you want to offer your thoughts on Facebook right now.
Hey, Neil, you're muted.
Yeah, I know. I just fixed it. I'm just doing the screen share now. Yeah, the screen share button's not working for me right now. Can you come to me after, Dean, please?
Yeah, Jim, go ahead.
Yeah, Dean, you have a chart of Facebook up there, right? Yep.
Yep.
Okay. My view on Facebook is that obviously it had a very big decline, and that 150 area was very key. So we saw 150 get hit pretty recently. So if you're looking for a trade, you want to be buying against that 150. You're already up 8 points on it at 158. Plus, it's up a couple of bucks in the aftermarket. So you already had a $10 bounce. Where could it go? 168 is the 50-day. 179 is the 200-day. If this tech rally continues, I guess 180 is not off the table, but I'm not convinced that it's in a brand new uptrend just yet. But you did have a trading opportunity for sure when it went down to 150, and people who did take a shot at it down there, they're getting paid right now. So I like it for a bounce here with a 168, 180 ceiling on it possibly, and I think obviously the 155 or less would have been the better place to get in, but it still may have some legs.
All right, so Jim likes it. Long on Facebook. You got it together there yet, Neil?
I think he logged back out, or logged out and is logging back in now.
Oh, we lost him. Okay, well, I'll go ahead and offer my thoughts on Facebook. So you can see my chart on the screen here. Of course, we had this big gap down here, which was big. And since then, we've had a consistent series of lower lows, lower highs, lower lows, lower highs. And so that is the definition of a downtrend, according to Dow theory. And so it is in a downtrend. I wouldn't take it long for any money right now. It may pull up a little bit before it takes the next leg down. So in order for me to be getting interested in being long, it would have to have a change in trend, which would be a high, higher, low, new high. Until we get that, no longs for me. And it's already a pretty mature short, so I wouldn't touch it. There's no trade on Facebook for me at this time. That's all I got to say about that. Unless hopefully we get Neil back.
Yeah, I'm back here. I just had to relog in.
Right.
So here on Ichimoku Cloud, people will think that this is support here, but there's really no such thing as sideways support at all, unless there's some type of support line. So then I just go to a different time frame, and it's from the monthly to the weekly chart. Well, I'm not sure why it's not showing the whole chart here. But looking at it earlier, I don't like Facebook really at all. Now there's just no type of a great trade here. Let me try to work on my charts, Dean, and then I'll come back for the next pick.
Okay, we'll go on to the next symbol, which is Baidu. And
Hold on a second here.
go ahead, Jim, if you want to offer your thoughts while Neil's working on the technology there.
Okay, give me 1 second here. The meeting next month between Trump and the head of China over the G20, obviously going to be a very important thing for that situation. It seems to me like the Chinese market is turning up a little bit lately after having a very big decline, and that's the same thing going on here with Baidu. So you got the 52-week low at 189, and you've got gaps above the market. And these gaps may very well get filled up here. So, if I had to do anything with Baidu right now, it does look like it might be getting ready for a pop. There is a gap between 225 and a little bit above it. And so it wouldn't surprise me if we're going to try to go up and do something with that. So using 189 as a line in the sand, which is the 52-week low, I would be trying to look for this thing to have not dissimilar to the Facebook, looking for a market that's been downtrending to maybe have a bounce. And 220 and 240 are two reasonable places to look for it to rebound back to. So, from 200 to 220 is nothing bad about that. And again, 189, just like 150 on Facebook, those are your lines in the sand. And if news start improving about the China-U.S. relations next month, that could be the fuel to get this thing hopping a little bit right now.
All right, Neil, you able to do your thing now?
Yeah, I agree with Jim. 240 for a price target for Baidu here on point and figure charts. This red line here would be the resistance line, so it's obviously in a negative trend. But when you get such a move down so fast, you can rally back up to that resistance, which would be right around 240. And then when I go to an Ichimoku candlestick chart, it's about the same back up here to about 240. But I wouldn't play this on a rebound. There's better options for a rebound here if it keeps going, and we'll get to that, I guess, later in the show.
Yeah, and so my comments. Jim said his comments on Baidu were similar to his comments on Facebook, and so are mine. I don't trade against the trend. I'll trade a correction once it's proven, but it's in a correction. Still technically in a correction. It has not put in new highs. It has not taken out previous higher lows. So it's still in a downtrend, and I wouldn't go long. I just don't go long on downtrends. If it's going to reverse, it'll prove it with price action, with a higher low, new high, and momentum will shift. And I'm willing to give up a few points of profit for more probability. And the probability on this one is it's going to keep going down. It's in a downtrend. That's how I read the price action right now. Could be over, could go up, but it's got to prove it before I'll go long. And it's too late to go short. So there's no trade here on Baidu for me. That's my take on it. Next up is Micron. And Neil, we'll try to get back to that order.
All right, sure. I just put up the point and figure chart here, and you can see the 17 here means 2017. So an incredible run from 15, 17, all the way up to the lower 60s. And the amazing thing about point and figures is trend lines. You can see that you would think, how could they possibly happen? But this blue line here goes up at 45 degrees for the last 2 years, and as soon as it was touched at $41, it immediately rallies to 47. But the breakdown would here be at about 40. And a stock like this, if it breaks down, it could go down to 20 or even lower. I mean, there's just no way I would be buying Micron. And I'll look here on the Ichimoku cloud. It's broken the cloud here in the positive trend. But look at how incredible the Ichimoku cloud works. If you were thinking about this stock way back here, you just wait until it crosses the cloud. Typically, I don't like it to cross the cloud, and then I won't get in right away. Move, but if it hangs out for a few candles and starts moving, you're looking at $20 all the way up to 40 just by playing the cloud cross. Of course, there were some times up here to get out as well, but I wouldn't buy it now. No, there's probably better names also in that sector, or you could do a leveraged ETF.
All right, Jim, what do you got on Micron?
Well, the semis did turn around a little bit, and so again, similar to your Facebook and your Baidu, these are companies that got whacked, and obviously there are people out there trading, and if you're looking for a possible trade, then again, you'd use 40 as your line in the sand, and from where we are now, a rebound towards 47 or 50 is not off the table, especially if the entire sector goes up. It could get dragged up a little bit by that as well. This is a good idea where, a married put and a stock position might make you sleep a little better at night because you'd have limited risk on the put and it would offset the exposure at the strike price. So, like I say, if I had to make a call on this thing, I think it could bounce out of here because of the general vibe out there improving in semis this week, and maybe that'll roll over a little further if some of these guys announce some good earnings.
All right, this one's an interesting chart and an interesting case study, because I showed on Facebook and Baidu that they're in a downtrend. And if I just switch back to Facebook, I'll just reiterate that point. It'll help me with my analysis here. So Facebook again has been with lower lows, lower highs, lower lows, lower highs, lower lows. Definition of a downtrend. It's been going on. That's until that shifts, I'm not going to try and trade it long. But if we look at Micron. First, I'll point out, and I agree with Neil, the Ichimoku cloud is amazing. You can see I got the shaded area here. We've got unique settings on the Ichimoku cloud, but the concept is the same. And you can see, all-time high, and all of a sudden we get a low, lower high, new low. And as it broke the cloud, That was a good entry. You know, my initial stop would have been here, and then as price played out, right, I would have trailed it to here, right? And so you're technically still short on Micron, but something is happening down here at the bottom, which is tremendously interesting. After a dramatic series of lower lows, lower highs, right? Clear pattern. Now we've got down here potentially, and it's not there yet. We got this low pulled up, and then this did not go on to a new low. So this is the beginning of a potential trend change back up. If it goes above this high, and I'd wait till it broke the cloud, right? There could be a really good long coming. It's early, right? That's about 50 bucks. We're down here at 43 bucks. But if it does, and this is a very simple approach to Elliott wave, but you can see I've drawn Fibonacci retracement lines. So after this amazing uptrend, right, from sub $10 up to 65, that move up's wave 3. We had a perfect retracement down here into the Fibonacci retracement zone. And now that if that next move up begins, and I showed what I would be looking for, right, the target for this next move, you know, if we can get up above about 50 bucks here, the target for the next move is between 73 and 94. That'll take weeks or months to play out, but that's, this is a daily chart. We're looking at, you know, a year and a half worth of data here. That's what it looks like. So I think it's worth waiting until we get above about 50, confirm that next move is coming, and then take that baby long. So that's one to watch for. It's not ready yet. That's my thoughts on Micron.
Yeah, one last thing, Dean, on Micron is that in the fourth quarter of last year and the beginning of this year, there were high points right around, you know, the 40 area, and it seems to come down into this area. So sometimes resistance becomes support on the way down. So that's another reason why this neighborhood may be very interesting if it can hold.
Yeah, and again, I'm not interested until it breaks above about 50 bucks for a long. All right, SPY, the S&P 500. Go ahead, Neil, if you want to offer your thoughts, sir.
Sure, just putting it up on one figure chart. And what happens on something that's kind of slow is you can't really tell anything from this chart. So what I do is I go down here, I go to the chart scaling method, I go to a percent. And for something like this, let's do about 0.5%. Things to see here. So yeah, this long tail goes down, and then I would say a target would be at about 284, which
yeah, we really can't hear a thing you're saying, Neil. It's all.
I think I was too far from the computer. Is it better now? No.
No.
Okay, well, why don't you come back and I'll see if I can close an application or something.
Yeah. Okay, SP 500, Jim.
Well, I've been pretty accurate on this one because during the decline, people were wondering what's going on, and I did make a statement at the podcast last week that if we could hold and if you wanted to go long, you would defend to 2690 area. That was the lows of June and July. And I thought if it did not take out those lows, I thought it obviously was getting very oversold very quick. And I thought the VIX, when it went to 30 and then started fading, was starting to look like a typical crashy type thing. So the line in the sand was established, as far as I was concerned, at 2690. And obviously getting long off of that number, you know, has been a very good thing here today. Now, as far as where we are today, we've come a long way. The VIX is obviously back under 20. I think that's very good for the people who want to be long the market, because when it's above 20, I think it's a dangerous thing, because all of your big problems generally happen after that. But now your problem is the equilibrium has been around 15 on the VIX. So now we're pulling back at 1762. So the we could obviously sense a very big short covering rally today. And so if the volume doesn't continue, although the Netflix announcement obviously will probably be positive for the NASDAQ. But my view here is this. My view here is that we're pulling back here on the VIX. Getting under 15 would be very bullish in my view. And again, I was thinking that if certain things break, we only got 10 weeks till the end of the year, right? People, have a hard time quantifying that. And some people were thinking we could see a very big up move by the end of the year. Well, if it's going to happen, things like the midterm elections will probably be very favorable for the stock market. The China meeting with the G20 next month will probably be very favorable for that. And then, of course, the earnings seasons will maybe not only be having good earnings, but also the guidance will not be as negative as people think. If you add all those three things together, then that could be the recipe to take this S&P back up strongly. But right now, I'd still be a little concerned as long as the S&P is under 2850 and as long as the VIX is above 15. So to sum it up, I think right now it looks very constructive. I would be concerned, I wouldn't start buying it up against 2850 or anywhere near between here and 2850 because it could very well be a situation where we roll back down. So again, with the VIX above 15 and we're up near 2850, I would be cautious up here, and I would not rule off the idea that we could roll back down to the downside a bit, do some retesting, consolidation, that kind of thing.
All right. And Neil, see if
am I coming through okay on the audio now, or is it still not good?
Yeah, much better, much better.
Okay, so I've got the S&P 500 up here. This is the point and figure chart, and sometimes if you can't really tell a lot from the point and figure chart, here I'll go to a different time frame. So I'll go to a percent, 1/4 of 1%. So this is really fantastic. So every box that you see here is 1/4 of 1% of a move. And so when it's in O's, it's continuously going down until it reverses 3 boxes and then it goes up. So here, I mean, this was a great breakout right here. And so now I would look for a target at about 28.76, and that would be the end of the rally where we basically would go back to cash. And if I look at the point and figure or the cloud charts here, this is a daily. It broke the daily, but you have to be careful on some of these little breaks of the daily. And to be more sure, you would go to a weekly chart, which is basically the long-term chart for the S&P 500, where if you only used the cloud and nothing else, you would still do totally fine and all the crashes. So right now it's still above the cloud. And if I go way back to 2008, 2009, you can see that it broke the cloud over here. And then it would get you back in at right about 1,000. So, yeah, my target for the rally would be 28.83.
Okay, and I'm showing a daily chart of SPY. It's funny, the headlines today, I saw in the financial press lots of headlines about, the S&P and the Dow clawed their way back. It's like, really? Did they? Because I see the down move from the high as we're only back about 25% of that. So I don't think we've clawed our way back from anything yet. And what's interesting is the S&P 500, you look at the SPY, you look at the S&P cash or the futures, same thing. We had a solid close below the 200-day moving average for the first time in years. That may mean something, that something new is going on. We broke definitively through the Ichimoku cloud, and now we are coming up under it. So from a technical standpoint, this looks like a potential trend change down. Now it's early to try and call that. I would want to see it reverse off the cloud and come in and put new lows. If that happens, we got a much bigger down move coming. Now that's based on the current information. I'm a technical trader, but and price action is the only reality. But as new information comes into the collective participants of the market, then the reality could change. So the events that Jim mentioned, the midterm elections could have a big impact, and how earnings come in collectively could be a big deal, both the actual earnings and the forecasts. So based on the information we have right now, based on the technicals, right, something new happened, breaking through support, and right now we're looking to see if it would reverse and continue that downtrend. But that could change. It's a little early to call a downtrend, but if it does reverse, take out this low, we got a big down move coming. Bank on that, but not there yet. And that's 95% of trading is waiting for something to happen, right? And 5% is execution. All right, AMRN is our next victim here. And holy smokes. Talk about new information entering the market. Yeah, there's some new information that came in on this one, apparently. What do you think, Neil?
What's the new information? Hold on.
Well, I don't know, but it went from a channeling market at $3 up to 20 in the blink of an eye.
Yeah, I know. I saw the chart.
So I don't know what the information was, but something new happened.
This is a pharmaceutical company.
Because I remember the drug, yeah. Right.
Yeah, normally when you get a huge gap up for something like that, which is almost certainly news, of course, then you're not going to get a massive follow through forever. So this follow through is tremendous, and I don't see any reason to buy it here. But why not just buy the breakout at around 21.71, something like that, and you could get a double out of it if this is for real. So that's what I would do. I'd get a breakout around 21, put the stop at about 18, and use a position sizing. So you're not losing too much of your account if you get stopped out, maybe 5% or so on this.
All right. Jim. Amarin.
Well, this is a market I think that I think we've seen some of these, Dean, in other shows. And the remark I always have is if you're in there, enjoy this ride. And if they have puts out there, you might want to buy some married puts every once in a while if it's not too expensive. And then try to ride it as far as you can, knowing you have an umbrella underneath the market. But, anything that's going for 20 where the 200-day moving average is at 4, I don't need to be told that that's a boat that has sailed for me. But if you were going to, chase it or something like that, I'm sure there's other strategies. But as far as I can see, it's something that if you're in, enjoy the ride and consider some hedging techniques so you don't give it all back in case something turns. And again, it has been trading 3 times normal volume here on a 50-day average than a 200-day average. So the money's been plowing in here in a very big way, and the 50-day moving average is a very high volume versus the 200-day. So the money's flowing in for sure, and the price is going up, and I'm sure the news was quite lovely. And so if you're in there, Lord knows where it's going. But again, if you can try to do some type of hedging tactic to make sure you come away a winner, that's not a bad idea as well.
Yeah. And I don't have anything new to add. That horse is out of the barn for me. I won't chase it. Beautiful. Wish I'd been there, but I wasn't. So I'll move on. Pan W. Palo Alto. What do you think about Palo Alto networks there, Neil?
I don't like it because it's down today when everything's up, and that's obviously a problem. So I wouldn't go in there. It broke down just like everything broke down. But no. On a day like today, if the stock's not up, that's a big problem. So
okay.
I don't even care about the chart really. On a day like today, if it's not up, you can forget it.
Unambiguous. Jim, you like it?
Well, I tell you, I wouldn't thumb my nose at it right now because, one thing they haven't mentioned much on financial TV and everything is that a lot of the market stocks were way overbought versus their 200-day average. Case in point was Amazon up at 2050 with its 200-day moving average at 15 or 1600. I mean, so a lot of the pullback that we may have seen here just is another way of offsetting a very overbought condition on many stocks. This is another example of that. You went to as high as about $240, I guess, around September 13th, which is what, a month ago? And obviously, then your 200-day moving average was down around 196. Now you're at 205. So there seems to be some decent support between, not support, but let's just say there's some activity between 190 and 200. So that would be an area that I would draw a line in the sand as far as I wouldn't want it to go back any further than 190 or 200. We're at 205. And then obviously it's in the software business. And, Software stocks can be very volatile. So I would probably monitor this thing during this decline here that it has and see if it holds the 190, 200 area. And then I would try to look for some formation that would make me feel good about taking a shot at it in that neighborhood. And then see if it might go back, particularly if the entire sector of software is doing quite well going into the end of the year. Because obviously tech, got on the bicycle pretty heavy here today. So people are not unwilling to buy tech apparently because the tech sector, is going nuts a little bit. So again, I would look at the 190 to 200 area as a area of support, worst case scenario. And if it got back above 221, which is the 50-day moving average, that would be very constructive.
Okay. Well, it has been in a long uptrend for sure. And it had a pretty big correction right back down to the 200. It did not cross it. So I'm not really excited about it. I think it may continue the correction, but I wouldn't be interested until it crosses the 200. And at that point, if it does, there's not much profit left into the Fibonacci retracement zone. So this is one I have no interest in trading. And that takes us to Canopy. So apparently tomorrow's the day where you can go legally buy cannabis in Canada. And of course, Canopy is a cannabis stock. And we actually traded cannabis, took it long at $29.74, took it up to about $50. So that was fun. But Neil, what do you think about Canopy right now?
I don't like it at all. It's pointless to buy. It looks exactly like a false breakout. And then again, down today when the market's down. Buy the rumor, sell the news. It's over.
All right. No fuzziness there. It's over.
Buy the rumor, sell the news, man.
There you go. Jim?
Yeah, it fits into the category that I would be looking for places to sell. Because again, like I was saying, when we were way up and all those stocks were way above their moving averages, I had been telling people along the lines of look for put opportunities or covered calls, or if you're in these things, do some collars up here, because when you get this far away from the moving averages, the probabilities are very favorable. You're going to get a sharp pullback. Now, this is the kind of stock where obviously it can feast or famine on you very quickly. So I would just say that with the high being 60 and the 300 and the 200-day being average at 30, this would be the poster child of the possibility of pulling back on any news that's sobering at all. And it seems like a lot of the people who wanted into this stuff have gotten in, obviously. And so there has to be a couple of people who might want to take some profits if the news starts turning a little bit. And like Neil was saying, down $4 on a day like today is probably not an endorsement, huh?
Yeah, like I said, we did trade Canopy and a couple other Chronos and some other ones in the sector. Did really, really well on them. They were a little bit more orderly. Up here after the big run, this one and a couple of the other big cannabis names, it turned totally to static. Went from an orderly market where you could see some moves and use some indicators and some analysis and have a probability about what's going to happen next. It turned up here, you can see in beginning of September, into complete static. It's just like a TV with snow on the screen, right? You have no idea what it's going to do next. And I don't trade markets like that. So it was a great run. I'm out. And I think both of you are right. This thing could do something completely unexpected against you, whichever way you're going on it. And that's not how I trade. And you could end up losing a lot of money, and then you'd have to go get some of their products and to feel better, right? Let's look at one more, and then we will do the panelist picks. But let's look at Bank of America. And Neil.
I don't like it either. Banks have been weak for several months. Just there could be a lot of rhyme and reason to it fundamentally if you think banks should be making more money, but the housing is going down to make a lot of money off mortgage loans. And so I think that's been showing in the chart. Look here, August was the peak. In the market, I think it was just a few weeks ago. So no, I don't like Bank of America. I don't like any banks at all right now.
Okay. No on the banks. Bank of America and any bank at all. What do you think, Jim?
Well, I think that people have been pounding the buy financials drum so loud, I got a headache. You know, everyone rushed into them in January. It's supposed to be the sector to be in because when interest rates go up, these guys make a fortune, and so you got to get in now. And you know, this chart on Bank of America is very similar in respects to many large companies and many indexes, in that we made a lot of high points in January, February this year. Then we had a correction, and then we had a rally back up. And the rally back up has failed to take out the rally highs of January and February, or some of them came up and just met them. And now we've rolled over to the downside. So I think, you know, what Dean says is if we did get further weakness and took out some lows here, particularly 2690, like I was talking about, then the severity of the drop may be far greater than people think. You know, the 2-year note today is getting very close to 3%. And that means that the banks have to pay out a lot more than they had to. So the free money and the spread there has obviously tightened up quite a bit. And that and loan demand not being that fabulous and other factors, you know, probably are putting a little bit of a lid on these banks. Again, you know, if they start trading better than this, I'm not prejudiced. I wouldn't mind getting into them, but I don't like to, you know, get into things like this where they don't seem to be able to hold any gains, and they seem to be languishing. And if higher interest rates are supposed to help them, then obviously they should be doing better. And when something's supposed to be doing better and they're not, then obviously that's a warning sign.
Languishing, that is an outstanding term for the bank stocks, Jim. I love it. And that's, you know, you just look at this chart from January till now. Languishing is the perfect description. You know, I'm scratching my head as I hear some talking heads talking about banks make more money as rates go up. That's kind of like saying gas stations make more money when oil goes up. Do they really? Not really. They actually have to go buy gas at a higher price, right? And I think banks have to go buy money at a higher price. And so that's my analogy, right? Don't like it. The thing's going completely sideways in a channel. It looks like a game of Pong, right? You know, down to the bottom, badoop, up to the top, badoop, down to the bottom, badoop. So I don't try to trade that. Not interested in it. Hey, let's take a break. We're about halfway through the list. Why don't we, and I think we have been complete downer wet blanket guys on every symbol we've looked at. I don't think anybody's gone, that's the one, man. Get your position on tomorrow morning at the open. But let's share what we do like, because we're all positive guys. So Neil, what do you like right now that you would share with the folks listening in?
We actually got into SPXL, triple leveraged S&P 500, about 47.50 today. It worked on the buy stop limit break post, so I think this can rally up to around 52. I like that. One thing you have to look at also are bonds. This is TLT. We got the puts bottom down here, and everyone knows when interest rates go up, bond prices go down, but in the short term, you're going to have a lot of fluctuations too. So if this is something to look at, and if bonds rally up to around here, 117-ish, and then the market's rallying again and the Fed gets aggressive again, then you're going to have a good chance to get some puts on TMT or buy TMV. I guess I was bearish on that. Sorry about that. But it's a trade anyway. And here's a nice one, AMD. A lot of people are talking about AMD, or they thought that it couldn't rally. But look at this, how amazing the cloud works here as soon as it touched it. But a touch on a big move down is not enough. So you have a breakout here. And I would get into AMD today, to be honest. I think you can have a move up to 32, you know, in this area, and then really more. And I actually got another chart. I was getting ready for this. This is a very long-term chart of AMD, because I know that it rallies. It can really, really come back from the lows. So back here around, you know, $8 to 40, and then it had the big one here again, $6 to 40, and then down here, $2 to 30, and it can break these previous highs. I mean, if you include inflation, that would, even to hit 40, inflation from 2000 is at least double or triple. So 40 would really be 80. So we get a breakout here around 33 on AMD. I think we can have a rally. We can have a double on this stock in the next year. even though it's rallied tremendously already. Those are my picks.
All right. Very cool. Thanks. AMD. I'm looking at the chart there, and I actually like AMD as well. Jim, what do you like?
Along the lines of the healthcare and the biotech and the drug companies. So, companies like Biogen and Amgen started to turn the corner here today, and they look like they probably would follow through from what I can see. And United Healthcare obviously had a big day. So the sector of healthcare looks like it's got pretty good footing here, and within that sector, the biotech, which had a big drop, we had a big drop in Biogen. The 200-day moving average is down at 313. We're now around 330 something, coming off of 320 something. So it looks like that correction may be over, and it could be a situation where it could be ready to go someplace. So I think Biogen, Amgen both look pretty good, and the bigger companies like Pfizer, also look pretty good. So, but those biotechs look like something's going on as far as a possible turn. And so it might be, since they've had a correction and they're just turning now, maybe they're going to have some legs.
All right. Interesting. Biotech, healthcare, et cetera.
Mm-hmm.
So my pick to share with people right now is a symbol you've probably never heard of, and it's symbol XXII. And that is 22nd Century Group, and it is actually in the biotech health space. And from a technical standpoint, we got a really good chart here. We've got a big wave 3, a perfect wave 4 correction, and now clear evidence of the next trend, the next leg up beginning. We got a target on this between $4 and $5.49. It's a lower price stock, trades at great volume, plenty of liquidity. And so the technicals are good on this. We got in it at 285. There's still time to get in. Had a big day today, but we think the target again is up over $4, and we're going to take it there if it'll go, and that'll be a really nice, nice win. The other thing, the cool backstory on XXII, supposedly the FDA is pursuing legislation or regulations or whatever that the nicotine level in tobacco products has to be lowered by about 90% to make it less addictive. And XXII has the only solution. They hold a patent on the only known way to grow tobacco with 90% less nicotine. So that's kind of cool. So I'm not a fundamental trader, but it's always fun to know the backstory on a company you're trading, and the technicals on this are great, and it's getting ready to take off. So that's my pick. 22nd Century. Next up, Amazon. All right. What do you think about Amazon, Neil? I think
Neil,
you're
you're
muted.
muted.
Okay. I get this weird feeling. This is a sort of a hunch feeling about Amazon. Is I think people are just kind of sick that Jeff Bezos is so rich now, and try to buy things from Walmart online and other stuff like that. But anyway, here's the chart, and yeah, you might get a bit of a move here up to around 1920 level, but no, I'm not bullish on Amazon at all. They got the problem with the U.S. Postal Service now. Maybe they're going to create their own trucks. Here's a weekly chart. Yeah, 1920 or so, I think, is the target. But I think they're going to have some strange fundamental problems, and I think they're going to get a bad rap in a way, just because I don't think people want Jeff Bezos to be so rich. That's all.
That's so in my trading room, sometimes we'll find a good setup, and there's just something about the company I don't like, or I'm not comfortable with, kind of the background. And I tell people, yeah, I think it's okay that if, even if there's a setup that looks technically correct, if something about it bugs you, go find a different one, be able to sleep at night. Don't worry about it. Right. So I think that there's wisdom in that. Go, I just don't like it. Right. Something about it bugs me. It sounds like that's where you're at. Something about
breakout, right?
What's that?
I don't like it, but I'll still buy it on the breakout if it looks good.
There you go. There you go. Jim.
Yeah, this was the poster child of overbought when we went to, like I told you earlier, 2050. The moving average was down around 1,500. Now the moving average on 200 days at 1,644. Still plenty of real estate between where we are and where that is. The thing that got me about this company was I saw something on a financial show that was showing the amount of revenue that comes into Walmart and Amazon. And I don't know if this is correct or I missaw it, but it seemed like Amazon was 3 times the market cap of Walmart, but only half the revenue comes in, which would tell me that this is a fairly expensive stock, and it obviously has been. But the point is that there is a point where that becomes more of a factor. And I'm just thinking, I'm just thinking out loud that the valuation of this thing is something that is almost like a ticking time bomb. Like Neil was saying, if something would happen where the government or somebody challenges them, like they did with Facebook, look how fast Facebook went, into the fade mode. If people started, if someone challenged either Bezos or their model or their tax structure or whatever they got going on over there, anything to put a fly in the ointment. When I saw the 3 times the market cap of Walmart, but only half the revenue, that kind of hit me as weird. And then, of course, the overbought nature of the thing trades at is also a little weird. So as far as loading up on it, it's like doing any of these ones where you're kind of discounting the future. You can put your money up, and then if you're in the right thing, if it keeps growing and if it keeps getting into market shares all over the place, you might be able to come out on top. But right now, I'd rather see it settle down for a little while and maybe try to get closer to some decent value.
I think they're going to open up their own brick and mortar stores and call it Amazon Basics and sell all their own stuff there. Who knows?
Well, maybe when they switch from internet to the brick and mortar, like when they did with Whole Foods, maybe that's the beginning of their end because they're leaving their niche.
Yeah, it's funny you compare the market cap to the revenue of Amazon versus Walmart. It's kind of like Tesla, right? Tesla has a bigger market cap than General Motors, but you could park every single car they've ever made on one of GM's parking lots, right? And maybe not notice them. It's funny, but momentum and emotion and all that stuff are what they are, right? Yeah, I'm not a buyer on Amazon. I think they may be beginning a correction. This pull up may end under the cloud here, and then would be probably looking at another move down. That's what the analysis looks like for Amazon for me. Here's one I never heard of, SSNC. Can't wait to look at it. This might be the next home run. What do you think about SSNC Technologies, Neil?
Just making sure I have the right ticker symbol here, SSNC. Okay. Let me just bring this the weekly chart. I'm going to bring up the daily chart. Yeah, I don't know. I don't like it really. A big reason is when a stock is going sideways for so long while the market goes up, it's just losing relative strength to the market. And I mean, I can go way back to the whole year, 49, and it's below where it was at the beginning of the year. So no, you have to look at how something's always comparing to the S&P 500, and if it's getting stronger and stronger or weaker and weaker. So here, yeah, sure, it could rally up to 56, and if you hold it, that's where I'd get out. I'd set a sell limit to get out of 56, but wouldn't be buying, no.
The buyer, Jim?
No, I mean, you'd have to give it a little bit more time. It peaked out at 61 on August the 3rd, and so that's not that long ago. And it's been on the defensive ever since. And now it's into an area that's interesting because the former high point of January, February area was in this ballpark area. So I'd like to see it stabilize here a little bit and hold this 200-day average, which it's broken a little bit. And, maybe this might be a better thing to buy at 56 and then put your stop under 50 than it would be to buy it here.
All right. Yeah, I'm not a buyer here. It just broke under the 200. Now that looks like the 200 is some resistance. It bumped right up against it today. if it turns and takes out that last low under where is that, 49 and some change, I'm a seller. I'm short, and it's got a little ways to go into the retracement zone, midpoint of about $45. So I could be talked into a short on this if it takes out that last low. I would not go long this stock right now at all. Microsoft. Go ahead, Neil.
Microsoft looks okay here, sort of. You have to remember that it has a market cap now of 850 billion, and Apple's the leader with a little bit over 1 trillion. Unless I missed something, I know that Amazon's right behind Apple, teetering around the $1 trillion mark. So it used to be for about 10 years, since 2000, if any stock hit 500 billion, it could never really make it past 500 billion or so. But of course, the tripling in the money supply of the last 15 years, you have huge inflation, and that goes into stock prices too. So if you look at 850 billion now, that's 15 years ago like 300 billion. So yeah, it's okay. I would get out here right at the top at 116 and then see if it would rally, but I think there's better options there. I don't like to buy the massive market cap stocks.
All right, Jim.
Time till this sucker hits 2 trillion. Maybe.
It seems like a lot of the software companies have had a correction, and the question is, are they going to have further ones? This thing seems to have its support at the 200-day right around 100. So if you started seeing this thing under 100, that would be a definite red flag as far as the bulls are concerned, I would think. Then again, if you are a believer that we are going to get great earnings and guidance, and we're going to get the S&P on the bicycle again, and we're going to have China and Trump put at least a fake deal together to make people think that's off the table. And if Brazil's going to get going again with a new guy coming in, and Italy and the Brexit is going to be mellow, then obviously Microsoft's going to participate in it, in my view, because it's a part of all those ETFs, right? You can look at any ETF that has to do with the stock market, and you're going to see this word in there, every one of them. So this is more of almost like buying with the S&P. If you think the S&P is going to go take out the highs and go nuts at the end of the year, beginning of next year, this is a play down here with a stop under 100.
All right. And I like Neil's comment, but I don't really like trading these kind of marquee, huge valuation companies. I mean, to move Microsoft 10% from here is pretty heavy lifting, and with the mid cap stuff, moving 10%'s nothing. So I'd rather go play there. So I'm not interested in Microsoft up at these stratospheric levels. It might drift a little higher, but I don't think it's gonna. It's not going to double in the next.
You don't want to spot Arnold Schwarzenegger in the gym, is what you're saying.
Yeah. I'm looking for something that could really have a pop, and that it's reasonable to expect it would have a big pop. And like I say, taking Microsoft up 10% would probably be kind of the most you could expect. I'm a swing trader. I'm in trades 4 to 6 weeks. Microsoft's not going up 10% in the next 4 weeks. And so I'm going to go try to find something that is. And while we're talking about really big marquee companies, why don't we go ahead and talk about Broadcom? And you're up, Neil.
I like this better than the last one, even though it looks worse at first sight. I mean, it's been going down all year. It's really volatile. Been breaking a lot of bottoms, but even this big gap down here. But now it touched the cloud. It's rebounding a little bit. And sometimes when something breaks down so many times, like this, once it starts to break out of a bottom, you can actually get a huge rally. So, this, it's not in a very, sector necessary. I mean, it's Broadcom we're talking about, right? Yeah. Okay. Yeah. It's not in a sector with a tremendous amount of growth, but I think that this could rally. I mean, this could go up to maybe 300 in a year.
Okay. And Jim?
Yeah, and the here and now, this thing doesn't look very good. It's been having lower highs ever since. I think they made an announcement right at the end of last year that they were going to open up some plant, and wasn't the head guy and Trump shaking hands, and it went to 285. November of last year. And since that time, ever since that handshake, we've been going south on this thing. So again, selling rallies has been the way to go, and there's no evidence that that's changed. Right now, the resistance comes in right around 250, which was somewhat of a recent high. The moving averages, you've got them pretty much inverted, but you do have a rally here now. So if this thing can take out 250 and you can risk it to under 200, or at least underneath the moving average on the 50-day around 230, then it might make some sense. But I'd rather see some ability to take out the recent highs of 250 before I would worry about anything on this thing.
Yeah, I don't like the chart. It's a bit erratic. It swings around without, particularly, this year. There's been no rhyme or reason or pattern where you could see an impulsive move and a correction and a continuation. Those are the kind of things I look for. This is just a paint splatter. So I don't like to trade charts like this. No interest in it. Next is Twitter. I've been enjoying following the Twitter war between Jack Dorsey and the Salesforce.com guy, both San Francisco companies, and they've been going back and forth on a new tax to solve San Francisco's homeless problem.
It's always a tax.
What's that?
Nothing. I thought they were going to do it with all their billions, but then you said tax.
Yeah. So there's a new tax proposed on big companies that's going to solve the problem.
Right.
And
not the billionaires actually giving their billions to solve the problem, but
well, no, that's the Salesforce guy said, hey, rather than a tax, Jack, why don't you just go give a bunch of money?
Oh, okay, good, because I haven't followed it at all. That sounds pretty funny. Okay. And obviously he doesn't like it because wants.
Yeah, no, we should tax everybody else. What do you think about the chart there, Neil?
Sure, Zuckerberg could solve the homeless problem tomorrow if he really wanted. I think it's good. I mean, it looks really weak, the gap down, but you have this breakout off the bottom. And so, I mean, right here, when I see this sort of got out the weak shareholders here, this red sell-off candle. And then now we have the breakout. Well, we just need the tiniest little bit more. And it's just a trade. You could get maybe $15 level. And then I would just get out, just to trade. But you could get lucky in a week. You could make about 15%, up to about 34.
Okay. A little swing trade there. Jim, Twitter.
Yeah, I think that's about the best you can say right now on it, because obviously it's been on the defensive since the middle of the year. And again, it was another one where the 200-day average was probably around 30 and it was trading at almost 50. So obviously another example of when they get that far away from their 200 days, something is going to happen more than likely to make it go back down toward it. This thing here has gone through it and now it's inverted. 31 is the 50-day average and 33 is the 200-day average. So right now it's underneath that. And so, to get interesting on this, I would like it to get above the 33 area and then basically use whatever these lows are as a get out point, but try to get some momentum in there that might be sustainable. The only one positive here is that they do have volume that's been drying up on the decline. The last 50-day average volume is around 22 million or so, and the 200-day volume is 29 million. So, the drop has been accompanied by volume that's a little less than what it has been. So anyway, looks like it could have a little bit of a pop, but until it got above, 33 or so, I would probably be a little hesitant to get too long it.
All right. And yeah, I don't like it. I'm not going long. I'll watch. If it goes up close to that 200-day and reverses, I might like a short on it. But there's better charts for me to be trading right now. I'm not interested in it. Hey, we're out of time. I kind of lost track. Let's go ahead and just do a wrap up. Last thoughts. Anybody has any kind of closing thoughts? And if there's a link or a web page you want to share, this would be the right time to do that. So Neil, any last thoughts for you?
Let me just bring up S&P 500. I guess what I'm looking for is if we see a huge rally that comes out of this, Watch for a headline in a couple months that says something like "back to the races, bears are finished." That'll be a great time to take profits.
All right.
That would be it.
All right, Jim, closing thoughts from you?
Yeah, sure. I just want to thank everybody for being here, and of course, Dean for moderating. And wanted to invite everybody to go to the weekly market update that I have on the podcast by going to optionprofessor@gmail.com. That's optionprofessor@gmail.com. You can get the link to it. And at this weekly update, I go over all the different sectors, a lot of different markets, and I talk about different uses and risks of the options. Because again, hedging tactics, are so important. There's so many people that got totally waxed during this drop and find themselves holding on to long-term positions that they could have done some hedging on if they really understood the ins and outs of it. That's the first thing. So, and even now, when the market goes way down, maybe people are getting out. Maybe they could have hedged themselves by using the calls as a way of hedging the fact that if they're panicking out, maybe they're making a bad decision, and they could have got involved with some of the snapback that we're seeing. So with the options, there's a lot of moving parts, and I've been doing them for decades, so I'm pretty familiar with it. So try to tune in if you can by getting the link to the podcast, and see if you can keep in touch with me and ask questions each Friday.
All right, thanks, Jim. It was good to be here with you and Neil with you. And again, I'm Dean Jenkins with Follow Me Trades. It's my website, followmetrades.com. And we got a stock pick advisory service, track records here. We're doing pretty good year after year. Complete details of every single trade we've ever taken and published, listed on these green buttons. Results are audited by a third-party CPA firm. So what I say I'm doing, got somebody checking to see if I'm really doing it. And of course I am. And a great way to get acquainted is to sign up for my free newsletter, weekly market analysis called Beyond the Noise. That is it. Thanks, David, for having us back, and back to you.
All right. Yeah. Thanks, everyone. We got through a lot of the lists today. So just a reminder for everyone: be sure to subscribe to Timing Research on YouTube and your favorite podcast network. You can also go to TimingResearch.com to get access to any of the past reports or shows there. And be sure to join us next week for both shows. The 200th episode of Crowd Forecast News will be next Monday at 1 p.m. Eastern Time. And then the next episode of this show will be Tuesday at 4:30 p.m. Eastern Time. You can always go to TimingResearch.com/live to watch the live broadcasts. And just want to thank my guests again for this week: Jim Kenney of OptionProfessor.com, Neil Batho of TraderReview.net, and Dean Jenkins of FollowMeTrades.com. Thanks, everyone.
All right.
Thank you, David.